Everything you've been told about getting rich in options is wrong. The world's most successful options traders, the billionaires, they're not buying puts and calls, they're selling them to you. Today, I'm counting down the top 5 billionaires who built massive fortunes trading options. And I'm gonna show you exactly what they did so you can steal their ideas. Because after all, if you wanna get what other people have, you gotta do what they do. Simple as that. Hey, welcome back to the Cressivo channel. I'm Michelle, talking all about options, selling puts and calls for income. Every trader on today's list sells options. Every single one of them. And by the end of this video, you're gonna see the exact strategy setups. Now, before we start, please do me a favor. Hit the subscribe button. First of all, you don't wanna miss an episode. I'm putting up all these amazing videos to help you be more successful. And secondly, the more people that subscribe helps other traders just like you find these videos. So thank you for that. Now let's start the countdown. Number 5, David Tepper, Appaloosa Management. Personal fortune, over $20 billion. Now here's his most legendary trade. You have to hear this. February 2009, the bottom of the financial crisis. The world is melting down. Bank of America was trading for less than $3 a share and Citigroup less than $1. Everybody on TV was screaming that the banks were going to go to zero. And while the rest of Wall Street was running for the exits, David Tepper was backing up his truck. He saw the opportunity. He buys the common stock, he buys the preferred stock, he buys the bonds, and he sells massive amounts of puts to collect the stock even cheaper. Everyone thought he was insane, but by the end of the year, Bank of America was up 300% and Citigroup up 200%. What did David Tepper get? He walked away with over $4 billion on just those trades. He saw what no one else could see, opportunity. You see, Warren Buffett says it the best. Everybody makes money when the market is up, but when the market goes down, that's when fortunes are made. And David Tepper capitalized on that opportunity. His fund, Appaloosa, returned over 132% that year, while everyone else was losing their shirt. The largest single year payday in history for hedge funds. Now here's what I want you to notice. He was not shorting stock. He was not buying calls. He got rich selling puts on stock that he genuinely wanted to own more of at the exact time that everybody else was too scared to buy. That is the lesson. David Tepper is legendary. Number 4, Ken Griffin, founder of Citadel and Citadel Securities. Personal fortune, about $50 billion. Now, most people have heard of Citadel, the hedge fund, but what I'm talking about is Citadel Securities, the market-making arm. You see, Citadel Securities handles roughly 1 in 4 trades. They are literally one of the largest options market makers in the world. Now, here's the uncomfortable truth that you might not want to hear. Every time a retail trader buys a put or a call in their Robinhood or Webull account or wherever, there's a high probability that Citadel Securities is on the other side of that trade, selling that option. It's a hard fact that most option buyers lose money over time. And sellers like Citadel Securities collect that premium. They get rich off of everybody else losing. That is the lesson. And when you sell an options contract, you are on the same side of Citadel Securities. The biggest players in the market are option sellers. Why would you want to buy? Do you want to join the everyday Joes who lose their money over and over again, swinging for the fences, buying an option? Or do you want to be on the side of the billionaire who sells them and collects the premium? Number 3, Carl Icahn. I love this story. Legendary activist investor, personal fortune in the billions. He founded his firm way back in 1968 on arbitrage and options trading. His most famous options trade, Herbalife. Here's what happened. Bill Ackman, another billionaire hedge fund guy, publicly announces that he's shorting Herbalife stock. He called it a pyramid scheme, said that the stock was going to go to zero. Icahn already had some Herbalife, and of course he disagrees. The two of them go on live TV and start screaming at each other. It becomes one of the most famous moments in history. A personal feud playing out in real time on live TV for millions of watchers. But while everyone's watching the drama, Icahn is building his position. Now, Icahn already owns shares of Herbalife, so now he loads the truck up. He built a massive position by buying an army of call options funded by selling puts. By the time he was done, he owned more than a quarter of the company. He squeezed out his rival, Bill Ackman, who lost over $1 billion on the trade, by the way. And Icahn exits his position with over $1.3 billion. Love that story. Now, before we get to number 3 on the list, let's talk about what can go wrong. Because options trading is amazing, but you have to have rules. Because when you sell options the wrong way, it can be devastating. You can totally blow up your account virtually overnight. Let me show you a real world example. Long-term capital management. Founded back in 1994 by what was believed to be some of the smartest people on Wall Street. Traders, and even 2 Nobel Prize winners who literally invented modern options pricing. Their strategy: sell massive amounts of premium. And they bet that markets would stay calm. Now here's the part that matters. They were literally leveraged 130 to 1. Meaning, for every dollar of their own money, they had $130 of risk in the market. Now that works great when your positions are going the right way, but it can be devastating if it turns the other direction. For 4 years, their strategy worked beautifully, making billions of dollars. Then in 1998, Russia defaulted on its debt. Markets panicked, volatility exploded through the roof. The trades that made them uber rich reversed. And with 130 to 1 leverage, there was nowhere to hide. The fund's equity collapsed virtually overnight. From $4.8 billion, they dropped to a little over $600 million. The only reason that they didn't go completely belly up was that the Fed stepped in with a big bailout for them. That just shows you the sleazy backdoor deals of Wall Street, but that's for another video. The lesson: in order to be successful long-term, you have to primarily be risk conscious. It's super easy to make money and it's harder not to lose it. And listen, if you lose 50% of your value, you have to make 100% just to get back to where you started. And let's face it, us retail traders, we don't have the safety net of a government bailout. So you have to make sure that your trades are consistent with the size of your account. And if you're using margin, you must know the number at which point you would incur a margin call. Otherwise, all of your paper losses turn into real ones. Now, every rule I teach here on this channel exists because of what happened to funds like long-term capital. And there are so many other examples just like them. Check out some of my other videos for more on that. Now, let's get back to our top 5 billionaire options traders. Number 2, our friend Warren Buffett, the most famous investor in the world. Now, most people know him for his buy and hold philosophy, but what most people don't know is that he's a giant put seller. Let me show you 3 of his big trades. Trade 1, 1993. He wanted to buy more Coca-Cola. The stock was trading at 39 bucks. So what does he do? Instead of going to the open market and buying a bunch more shares, he sells $35 puts. In fact, he sold 50,000 of them, collecting over $7.5 million in premium up front, cash in his pocket, right then and there. The trade? Well, if the stock stayed above $35, he keeps the $7.5 million and he doesn't buy any shares. If the stock trades below his $35 strike, he buys the stock that he wanted anyway at a discount and he still keeps the $7.5 million. It's a win-win situation. That is what selling a put is. You get paid, and worst case scenario, you buy a good quality stock that you liked anyway on sale. It's a no-lose situation. Trade number 2, 2008. This is a big one. When the whole stock market is melting down from the financial crisis, Warren Buffett sees opportunity because he knows that long-term, good quality stocks go up and the market will rebound. So what does he do? He sells long-dated puts on major stock indices like the S&P 500. Total premium collected over $4.9 billion. What a baller. These were 15 to 20 year contracts with fat premium. So when everyone else was running for the hills, he was selling insurance against long-term market decline. Again, because he knows that long-term, the markets have to recover. Trade number 3, and this is a good one too, Burlington Northern Railroad. Now, he already had some shares, but he wanted the whole company. And Warren gets what he wants. So what does he do? He buys shares and he sells puts. Every put sale gives him income and the opportunity to buy more shares at a lower price. Now you might be wondering, why did he even buy shares on the open market? Why didn't he just sell puts for the whole thing? That's a great question. That's because when you get big like Warren Buffett size, the options market alone isn't big enough for you. You're too big. In fact, he has publicly said that his size is often a disadvantage. There wouldn't be enough puts for him to sell to get him the whole company. So there's two lessons here. First of all, smart people, billionaire investors, they sell options. And the second lesson that's equally as important, if you think you need a ton of money to trade options and be successful, you are totally wrong. The math actually works better at smaller retail size because you can move in and out so much easier. Now, everything I teach here on this channel goes over these fundamental rules. Only sell puts on stock that you really want to buy at strike prices that you're okay buying those shares at. Keep cash on the side for dips because believe me, all stocks dip. And be comfortable with assignment. That's part of the plan. Let's learn from Warren Buffett. We collect premium for the obligation to buy the stock if the price drops below a certain value. A price we'd be happy to pay anyway. Same principles, same math, just a different scale. Now there's one billionaire on this list who has taken premium selling to a whole different level. Someone whose entire company exists for one purpose. And you probably never even heard his name. Yass. He doesn't really give interviews. He's not on TV. Kind of a ghost. But here's why he earns the top spot in this video. Yass co-founded Susquehanna International Group in 1987. Today, Susquehanna is one of the largest options market makers on the planet. His personal fortune, over $30 billion. And he's number one because he built his fortune on one principle, expected value. You see, he wasn't a Wall Street guy. He was a poker player, believe it or not. He spent his college years at the poker table and the racetrack. While everyone else was studying, Yass was learning something more valuable. He was learning how to price a bet. Then in 1981, he took the money that he'd won playing poker and he bought a seat on the Philadelphia Stock Exchange. And he started selling options. His company was built on one rule. Never take a bet unless you know the expected value. Poker taught him that. Today, his firm has thousands of traders, and believe it or not, they still use the poker game as part of their training program. Because for Yass, poker odds and option selling are the same math. And here's the lesson. That principle, expected value, that's exactly what you're doing when you calculate the annualized rate of return before you take a trade. You have to do that. Otherwise, you're guessing and you're gambling. You need to calculate whether the premium justifies the risk that you're taking on the trade. Poker odds, option selling, annualized rate of return, the same math. He is the legendary GOAT. Okay, so here's what I want you to take away from this video. David Tepper, the crisis investor. When everyone else is freaking out, he seizes the opportunities. Griffin, the biggest players in the world are option sellers. Know that. It's a fact. Being a seller puts you on the same side as the big boys. Icahn, sell puts to buy more shares of a company that you really want. Warren Buffett, selling options is just like selling insurance. There's no bad scenario when you sell a put on a stock that you already want to buy. Yass, calculate your odds. Know your annualized rate of return so you know if the risk is worth the trade. The biggest players in the market are the option sellers. You're either on their side or you're against them. That simple. Now, I'm not saying if you copy a billionaire, you're going to become a billionaire. But what I am saying is this. The most successful people on the planet sell options. You can literally do exactly what they do, just on a smaller scale. Same principles, same strategies, same math. Now, if you want to see how we run this live, check out my live stream every weekday at 12 o'clock Pacific, where I trade a real account. Check out our proprietary Cressivo app to help you find the trades, manage them, and ultimately not just make more money, but make sure you don't blow up your account. The link's in the description below. We have office hours every Saturday morning for app subscribers to help you be a better trader and answer all your questions live. And if you're serious about selling options at scale, check out my one-on-one mentorship program. I work with a small number of one-on-one clients each quarter. It's not for everybody, but if you've got the account size and you're ready to scale to build a real premium selling operation, applications are linked in the description below. And let me know in the comments below which one might have surprised you. I know it's hard to choose among them. Thanks for watching and happy trading.